Welcome everybody to the Thursday edition of the Not Your Average Investor Show, where we're doing JWB's Rental Property of the Week. This week's property generates 8.94% estimated ROI. It's located within one of JWB's core neighborhoods, as they tend to be, and delivers an estimated $186 in positive cash flow. We're live on Facebook for the Thursday edition of the Not Your Average Investor Show. Today is Thursday, and it's the JWB Rental Income Property of the Week. We are going to 2130 Holcroft Drive, which is a property that generates 8.94% estimated ROI and located in the heart of one of JWB's core neighborhoods. I am your host, as always, Pablo Gonzalez. Today, we got a guest host. His name, well, first of all, he calls himself, and he's called by others, the LeBron James of JWB. He is the inspiration for the original Stetson cologne because he's the man who makes it easy. He is born to wear a cowboy hat with that amazing facial hair. His name is, he's the senior account manager for JWB. His name is Mike Stetson. Welcome, Mike.
Hey, guys. How you doing? How is everybody? And Nadeem, I'm going to talk to you. Don't worry. We'll connect here in a little bit.
There you go. There you go, Mike. Welcome everybody that's in here in the chat already. I love seeing it blown up. John Henning, welcome. Lee Bishop, welcome. Dean Curry, we're going to roll call right here. Marilyn Cotterman from Homosassa, Florida. John Henning, I already said. Nadeem Shaw in the house. Kenneth Moline. Any other names? Am I missing any names? Greg Stone. Welcome, Greg Stone. Good to hear you as well, buddy.
I hear a lot of familiar names out there. Love it.
A lot of familiar. Lee Bishop with the assist, man. Home of the manatees. You said it, Lee Bishop. As you all know, everybody that's in here, because you're lighting up the chat, this is an interactive show, right? Like, we want you pitching in, especially today when we're going over this rental income property and breaking down the nuts and bolts. Two ways to interact. One is interact with each other in the chat. And for that, there's a little trick. You gotta, when you open up the chat box, it's only defaulted to talk to Mike and I. So if you want everybody else to see it, and you want everybody else to see it, because there is a ton of really smart investors in the house already, then you got to switch it from panelist to panelist and attendees in that little blue box right above where you're typing. And second, if you want me asking the question to LeBron James over here, then you got to pop open that Q&A. I love it, man. You're so stylish. I like the flick. You pop open that Q&A box and you put it in there, because that, quite frankly, if you put it in the chat, I'm going to try to keep track of it because I'm here to please. But if you put it in the Q&A, it's much easier for me to keep track of it because you're going to see this chat, a lot of old friends in here talking to each other. So it's going to fly, and there's going to be a lot of great comments. When it's in the Q&A, it just stays right in front of my face and I can't miss it. So you kind of idiot-proof it for me. And last but not least, if you want this spreadsheet that we're about to break down the data with, and you want to use it, not just to analyze JWB deals, but to analyze any real estate deal you want, straight from the horse's mouth, go to jwbroi.com and you get that. You're able to download the investor toolkit that we like to offer. Lee, I'll tell you how I went yesterday in a second. Actually, that's it, Mike. So, Mike, I guess we kind of talked about it pre going live on Facebook, but bring people up to speed on your role in JWB and why they call you LeBron James.
Yeah, and I think everyone here probably has a really good understanding of how we like to operate. But if you don't, we really want to start with what your needs are as an investor. And I think a big focus of our conversation today, going through the property of the week, is what a typical property with JWB is going to look like. And if we can confirm that our numbers, the market, our approach to managing properties is all going to be comfortable for what you're looking for as an investor, that's what we want to answer first. So my role here is to really help us figure that out essentially as quickly as we can. And then once we're able to determine that this makes sense for your needs as an investor, we're going to move forward with putting together your specific buying plan. What are the objectives? What are the time frame? How are we buying? What capital do we want to use? What do we need to keep in reserves? So we want to come up with a holistic game plan that ultimately we can execute. And not just execute now to get started, but over time, right? In a year, 2, 3, is this something that will continue to meet your needs as an investor? So we're going to have a series of conversations to be able to answer those questions. And then once we arrive at what the specific plan that we need to do for you, then that's how we'll be able to recommend properties and start building your portfolio together. So we're here to assist. We're here to help. I think that goes back to the LeBron James metaphor, right? Is you're not doing this on your own. If you're looking for a team that can help guide you, answer some questions, let's confirm this is going to make sense for us to have a long-term relationship together, then that's ultimately what we want to be able to answer for you.
I love it, Mike. Something about the way you talk makes me want to have a long-term relationship with you. And coincidentally,
no, don't tell that to my wife.
That's not what I mean. That's not what I mean. Listen, coincidentally, as you all know, we had a property on here last week, 7171 Lucky Drive, which I raised my hand during the show, said I was really, really interested in getting. And, I don't like to put myself in front of the line for anybody else. So we kind of left it open. And a couple of days later, Mike followed up with me and said it was still available. And today I just sent you the paperwork, right, Mike?
Yeah, we got it all signed, sealed, and delivered this morning, actually. So it is, nice where properties that we're reviewing on our property of the week are generally available. We do want to be mindful of all of our clients, and generally they do go relatively quickly, but we've always got another one up, right? And I think that's really where, our conversation, that if I think about it from last week, was, hey, if this one's available at the end of the show, great. It was, and we were able to move forward with it. So we want to make it easy for you, Pablo.
Listen, it couldn't be any easier for myself. I've kind of told my story a couple of times. If you're new here, I basically bought my first rental income property. I guess I put it under contract like in February, closed it around the beginning of March, maybe, or maybe I put it under contract in January, closed it end of February. I literally just paid the first mortgage payment yesterday, which was nice, cash flow positive, day one. And I had invested, I'll just say the dollars and cents, right? Like February 2020, before the world kind of went crazy, I put $7,500 into Peloton. That $7,500 at a certain point was like $48,000. And then the market took a dip and it went back down to 33. It actually went back down to like 29. I waited for it to take another little blip up to 33 and I cashed it out because I knew that I wanted more stable return and to be able to count on that cash flow. And I want to diversify out of, like this like high growth market stuff into like a very stable long-term asset. And for me, when this property came on, I was like, first of all, I like to gamble. So like, I like to hear this, I hear like 71 Lucky and it drew my attention. I saw the property, I saw the numbers. I told Greg before the show, I was like, man, I would really actually like this one, right? Because it makes sense for the down payment that I needed and whatnot. And he said, well, let's see if anybody takes it. And I said, fine, right? Like I've very much been indoctrinated into this idea that these are widgets, that at the end of the day, what JWB produces is a cash flow and an ROI. So houses are interchangeable and they all kind of like are the same thing over and over again. So I was totally okay with letting somebody else grab that property and not being nostalgic about it, but it didn't happen in 2 days. So Greg followed up with me. He said, I'm going to set you up a mic. And, it was pretty easy, man. Give me a little bit of, I was the first time buyer before. Is the second time buyer call like, I know the first time buyer, I was like the easiest or worst buyer ever because I didn't want to listen to anything you said. I was already in. As the second time buyer, is that kind of how it goes? People are just like, yeah, man, I just got this much more. Let's go.
That's actually a great question. I would like to say absolutely, right? I mean, every investor is different, but there's no doubt about it. The first purchase, the first step is by far going to be the hardest. If you're just thinking conceptually, it's a pretty large step for somebody to buy a house for most of our clients without ever seeing it, without ever coming to Jacksonville. So there is a high level of trust and belief in that first property. It definitely gets a lot easier when you start getting your rental income checks, like you could attest, right? So after that first purchase, I'm believing in you guys, but as that belief is confirmed with monthly income checks, then that really goes a long way to reducing the anxiety level. And so that second, that third, and each future purchase is absolutely a lot easier than the first. Why? Because there's an equity of trust that's been built up, right? And so you can draw from that. And at the end of the day, as you just alluded to, we're buying properties for the cash flow and that income that they produce. And if that's what I'm getting, if I've got a team that I trust to deliver on that, then it's a lot easier for me to continue building that relationship. So everyone has your own timeframes, your own pace that we're going to build the portfolio, but it certainly becomes a lot easier as my team delivers on what we've projected and expected from the start.
I like it, man. And just to, we're going to get into Nadim's question right now, but to give a little context around my pace, right? Like my pace was literally, I knew that I made a home run stock investment and I wanted to wait a year to not hit capital gains tax, right? To have that lower tax base when I pull it out. And the moment that it did, I was ready to cash out, but it was right when the market took a dip, right? So for me, that was my pace. My pace was, okay, I understand that I just created all this equity. I wanted to cash it out in order to put it into a more stable equity piece. And the moment it did, it wasn't the exact right timing. But then I talked to a stock expert buddy of mine. He's like, dude, if you set this like limit here and here, and I think that this is what's going to happen, I kind of set a window, cash it out, and then I was ready to go. And it fit my it fit my profile, right? Like for me, it was
Mhm.
very much about like the capital that I have and how much I can have left over. So we already got a question. We're going to get into Nadim's question because listen, we want questions, right? Put in the questions in the Q&A. The questions drive the show. So I want you to do it. I'll interrupt myself and ask Mike the questions as they happen. But I'm going to ask Nadim's question, and then we're going to showcase today's rental income property of the week.
Week.
So
My favorite
Nadim
part.
Shah asks, does one have to pay the listed price, or are these prices fixed, or can one make an offer?
Yeah, prices are fixed, Nadim. We do base it off of comparable sales. And we want this to be essentially we're buying properties because of the return that they can produce, right? And the sales price is part of that. But how are we basing our sales price, right? It is going to be derived off of comparable sales. And this is what that home on the open market, this is what should appraise for. So this is the sales price of the property. But another reason why we want to keep that property fixed is so that our clients aren't getting in bidding wars, right? This is not a negotiation where I've got clients that are making different offers and different prices on a property. And ultimately, any increase in price compresses your cash flow, compresses your returns. So we're not trying to essentially sell a property for as much as we can pay for it, or conversely, our clients aren't trying to buy a property for as little as they can buy it. Why we're buying this property is because this is the cash flow that I can expect over time. This is the return on investment that I can hold JWB accountable to. And if that's works for both of us, then that's the property we should move forward with. If this property is only going to work if I can get it for less than the sales price, then it's probably not the right property for us. And so we need to maybe revisit the criteria or the plan that we've put together. But ultimately, we're buying the property because this is a widget, it's a building block in our plan that we already put together.
That makes a lot of sense. Mike, do you get that question a lot? Are people like trying to like make an offer on the property? Is that common?
I mean, I get the question a lot. So I definitely would say it's a very common question. But if you think about it in terms of how can we help our clients the best, in today's market, prices are going up very, very dramatically. So I'm essentially, to maybe put it in some comparative terms, we're not like marking to market, right? Where I set my sales price based off of what it should be, appraised for, or what we can sell it for at a fair market price. But if that property is worth, $3,000 to $5,000 a month from now, we're not constantly adjusting our price. And that's really where we're at in today's market. So the concept of fixed pricing is so that we can all look at this spreadsheet, and these are the numbers that we can confidently move forward with. And so it's not making property available to all 500 of my clients at the same time, and essentially whoever offers me the most gets it, right? That's not going to how we can service our clients the best.
Okay. And then last question, Lee Bishop asks, so is it really first come, first serve on a property?
Absolutely. And Lee, you probably know better than most, right? Whoever puts the money down gets it. So there is a dynamic in today's real estate environment where there's a lot of clients, a lot of people looking to buy properties. And unfortunately, we've got, I don't say unfortunately, I'll say fortunately, we have a tremendous supply of homes, but it's not infinite. It is, a finite amount. And in today's market, I get about 15 to 20 properties each week. So we've got supply, but generally by the end of the week, they're mostly all gone. So whoever essentially puts the money down is who secures that property. And that's how we can always know that it's, like Pablo would say, we're not playing favorites, right? Essentially, it's out there until whoever puts their deposit down to secure the property.
All right. So without further ado, let's go to the property. We are magically being whisked away to 2130 Holcroft Drive, Jacksonville, Florida, 32208. Purchase price of $163,000. It's a 4-bedroom, 2.5 bathroom with a driveway. Estimated rent range between $1,125 and $1,175, and lease 2 or 3 years for $1,150. And now what you're actually here to buy is this estimated conventional financing total cash flow of $186, and this estimated conventional financing total ROI of 8.94%. Mike, the first thing that we like to break down on this show is, what is this estimated conventional financing total monthly cash flow represent? Like, what does that include? What does that not include? Talk us through it.
Absolutely. So we're going to talk about your monthly cash flow as what you would expect in a normal, typical month. So this will be your rental income, and then minus, I like to call them fixed costs. All right. So I'm going to have to pay my mortgage payment, which is going to be my principal, interest, taxes, insurance, plus my management fee. So 10% of rent collected. After all of those bills go out, what's left over? What is my typical monthly cash flow amount? And so for this house on Holcroft, after we pay all of those bills each month, we've got $186 left over.
All right. So that is the typical monthly, what you see on a typical month. What's an atypical month? What's what is something that might make that go sideways in any way? Or not sideways, right? But like what is an atypical month?
Yeah, I mean, it's not really a surprise. What would cause that number to deviate is going to be maintenance costs or vacancies. So there's always some other potential element out there, but generally speaking, the common denominator with the variation in your cash flow is going to be, is it a maintenance cost or vacancy cost? So those are going to be items that we reflect and look at on an annual basis. So when we talk about return on investment, we're going to take that monthly cash flow, and then this is where I'm going to factor in, what is my annual repair cost? What is my vacancy expenses that I need to budget for? What are some things that aren't going to happen, maybe even annually, things like tenant placement fees, right? Some of those other variable costs that will happen. The question is when. It's not monthly, but they are going to occur over time. So this is a big part of real estate investing. So we need to analyze that. Let's plan for that, account for that, and that's what you're going to see in that net result in the total return on investment.
There you go. So Sheila Bishop has a question. Are you counting tax savings or mortgage pay down in that cash flow number?
In the cash flow number, we are not. So we're going to make a very clear distinction between cash and then total return. So when I say cash flow, net rental income, that's going to be explicitly referring to what amount of money is left in my bank account essentially each month. Okay. So that's what's in my monthly cash flow. And then those items like vacancy and repairs are all going to be factored into our total return on investment.
Okay, got it. So you want to break down this estimated conventional financing total ROI number of 8.94% and what that represents?
Yeah. So this is where, like Sheila was just referencing, now we're going to take our monthly cash flow. So I've got $186, but then over time, there's going to be things that I need to essentially subtract for. Okay. So now I got to further reduce my cash flow by my vacancy cost, by my repair expenses, by my tenant placement fees, right? Those are all things that are also going to further compress my cash flow. One of the beauties of real estate is that we're not just limited to cash flow for our returns. There's other profit centers. There's other buckets that we can draw from that will, over time, enhance our returns. And so you've got included into that, let's talk about what we're buying conventionally financed. So you've got a renter that is making your mortgage payment for you every month, and part of that's the principal reduction. How much of your total debt are they paying down for you? And so we're going to recognize that principal reduction. And then we're also factoring the tax savings from depreciation. So we will include in those additional profit centers of tax savings and principal pay down, plus cash flow to give us the total return that we're highlighting here on this property at 8.94%.
There you go. Marilyn Cotterman has a question coming in here, which is something that you probably want to talk about here on the show. But Marilyn Cotterman from Homosassa, Florida.
Oh, hey, Marilyn.
Supposed to say home of the manatees. That's when I really miss GC there. But that's okay, Mike. You're a great pinch hitter. All right. So Marilyn Cotterman asks, is there a restriction on buying more than one home at a time for both new builds and renovated homes? So I think she's wondering if there's a distinction between it, but maybe you can talk about this restriction of buying more than one home and what's going on there, and then answer her question.
Yeah, happy to. And I would have to say over the last couple of weeks, this has definitely been the question that I'm getting the most is, can we buy one property? What's going on here? So let me start it off by saying here at JWB, we are very, very mindful of our commitments and our accountability to our clients. And so I just mentioned the amount of demand that we have at the moment for our properties, but we've also got clients that have been with us for, maybe like Marilyn, a couple of weeks, months. I've got clients that, like Lee, have been with us for a couple of years. I've got clients that have been with us for almost a decade. And really what we want to be able to do is fulfill the commitments to the clients that we've been working with. And so at the moment, we have a lot of demand on inventory. So we are putting together a game plan. Let me go back to the conversation with our clients where, initially we're going to put together a game plan. We'll be able to execute this plan. And if our plan is one where we need multiple properties, well, after we are able to close on that first property, we have the ability to buy more than one property. It doesn't matter if it's new construction or renovation, okay? We want to meet our commitment to our clients to help you put together and execute the game plan that we've probably been working on for many, many years. But we also have to be mindful of the inventory and demands on that inventory at the moment. So we have, restricted purchases initially, slightly to make sure we do have the ability to work with all of our clients. But as we continue to work together, if our plan is one where we're looking to buy multiple properties, we can absolutely do that for you. But we need to be able to balance what are our clients' needs, what are inventory at the moment, and also what's inventory looking like in the future. So there are a lot of demands, let's say, that need to be balanced. But at the end of the day, we're here to help our clients to the best of our ability, right? And if our game plan warrants us and we're looking to buy more than one house, we can certainly do so for you.
Yeah, and that makes me think that maybe we talk about the idea that this is a renovated home, right? Like JWB has new construction and renovated homes. I can tell from this one that it's a reno. Usually give me the difference between the what to expect from a new construction versus a renovated home from JWB.
Yeah, so there's going to be some differences, but you really don't expect a big difference, right? I mean, at the end of the day, just like you had mentioned earlier, why are we buying the properties? Because of the cash flow they return, right? Because of that return on investment. And if we're looking at that metric first, there's going to be no difference between new construction and renovation. They're going to end up at exactly the same result. Now, how do we get there may have a little bit of variation. Generally speaking, if we're looking at new construction versus renovation, the biggest differentiator today is going to be cost, okay? When you look at this property here on Holcroft, one of our rehab properties, this one's at 163. We can't be building brand new houses for $150,000, $160,000 anymore, right? So generally your purchase price for new construction is going to be on the higher side of that range that we're typically in. So you're going to have a difference in upfront capital to purchase properties. And then a further difference between that would be what budget do I need to prepare for my repair costs. So when we're looking at renovation homes, we budget, you can see there that 6%, comparing that versus new construction at 4%. So your primary differentiators are going to be cost to purchase. And then what is that, let's call it a 2% margin that I need to budget for if I'm looking between new construction versus renovation. So there's some differences, but fundamentally, it's the same property, right? It's the same return. It's in the same neighborhood. They're probably right next door to each other. So there's really no difference in the location, the types of renters we're working with. It's designed to be a similar property. The only question is, do we have to build it brand new, or were we able to take the existing structure and repair it to come up to a similar end result?
I got you, man. So as I hear you explain that, it makes a ton of sense, right? So I'm hearing for something new, it just takes a little bit more upfront, but then it's a little bit less to maintain. Versus something used, it's a little bit less upfront, but a little bit more to maintain. But at the end of the day, since JWB is reverse engineering really from the ROI and the cash flow, it's going to perform the same way in my portfolio. It's just the cadence of when the money gets doled out changes a little bit.
Correct. Yep. And exactly right. I mean, at the end of the day, we're going to get to the same destination, right?
Yeah.
The question is, am I doing a little bit more upfront, or do I need to just maybe budget a little bit more over time?
All right. Well, Mike, I want to get into the reason why this says 0% appreciation rate, but I'm going to dive into the questions first because I'm a man of my word, right? Like we said, if you bring questions, we're going to answer them. We're going to prioritize that. Nick Grandstaff, welcome, Nick. I don't think I've seen your name here before, and I appreciate you putting it into the Q&A here. He asks, who covers the cost of lawn care when JWB is managing a property?
So when the home's occupied, the resident will take care of lawn maintenance. When the resident moves out, we'll send our team, our cleaners and landscapers by there, so you'll be billed for that usage when it's vacant. But the typical expense is going to be paid for by the renter.
Okay, great. And Mike Foster asks,
hey, Mike.
In the spirit of JWB's under-promising and over-delivering, have you found the full market cycle average appreciation in JWB's home neighborhoods even better than the average annual 4.3% of the general Jackson metropolitan area? I think we're getting into appreciation questions, which I think you will appreciate. Go ahead, Mike.
Yeah, that's a great question, Mike. I mean, we're always going to want to be realistic with our numbers, but we'll take a conservative slant to it. I would say if we're looking at Jacksonville, we're very comfortable with that 4.3% historical number, right? I mean, that's going to come from a 30-year long-term trend line. But if we do want to get either more granular, right, or maybe even a little more short-term, I would say, we do focus, and a big part of our homework and our acquisitions team is looking for those areas that do set us up for that long-term appreciation, right? And if I'm comparing between the Jacksonville market as a whole and between what our clients have been experienced, I don't have numbers to support it that I would share with you, but I would say yes, that our clients have done better than average. But what I think is a better way to think about it, based on a lot of the data that we're seeing and tracking recently, is that just Jacksonville as a whole is growing at faster than a 4% appreciation rate. So a lot, and this I think since I got a lot of my existing clients here on our show today, you guys have probably seen where prices have gone over the last year, 2 or 3. And I would say, where are they going in the next 6 months, year, or 2 or 3? And that's really where I think we're seeing more of a shift. Actually, one of the articles that I was reading last week actually was that Jacksonville led the nation in home price appreciation in these metro areas. So, I mean, if you want to put a number on it, we're last year we're at about 21% in terms of market growth. So, is that greater than 4%? Yes. Do I want to make my investment decision solely predicated off of increasing growth rates? I push the brakes on that a little bit. But when you are looking at what is happening with real-time data, I mean, prices of properties have absolutely gone up.
Yeah, I think back to the client-only call report that they had where they forecasted that they're thinking that Jacksonville this year is going to go up 8 to 10%, right? That's kind of like the yearly short-term appreciation rate. To think that it went up 20% in the year of COVID is nuts, right? Like it speaks to all these like other trends that are feeding into the Jacksonville thing. And at the end of the day, I know that when Greg comes here and he talks about it, feels very comfortable in the idea that it goes up and down. Long term, it's always going to be 4.3%. So if you're like a 10, 20-year buyer, that's going to be the average. But for the time being, there's definitely seems like it's on the way up right now, right? Like with no we don't know when it'll taper off, but I guess that's what's driving this high inventory turnover, right? It's just like kind of like immediacy of just like getting in at a certain price for right now before the market cycles. Are you hearing that a lot in your sales conversations, Mike? Is there like a sense of urgency?
Yeah, for sure. I would say for a lot of my clients that I talked to today, the urgency is really going to be driven by a couple of factors. Interest rates, chief among them, but also pricing of homes, and where do we expect that to go into the future? I mean, there's concerns about inflation, and you talk about Peloton stock and what my equities have done, and maybe it's time to do a little bit more of a rotation or a asset reallocation. So there's a lot of factors that go into it. But in terms of why our clients are motivated to looking at properties, but I think going back to the essence of the question about this increase in pricing is really being driven by just all-time low supply. Fundamentally, there's a lot of factors that are putting upward pressure on real estate prices, but the biggest component to that is the lack of homes. And if we're just looking at it with our conversation today, we're real estate investors. A lot of you guys have bought properties over the last couple of years. So any of that inventory that's there has been soaked up. And there's not, like if we compare it to 10 years ago, shadow inventory of REOs and foreclosures and a bunch of existing homes that should come to market. So the only real solution for this supply side is home building, right? Bringing more units to the market, and that's got a long runway. So we are expecting this pressure in pricing to be here for a little bit of time.
I never dreamed that my economics degree would actually work for me at any moment, but right now it's totally redeemed itself. So supply and demand, baby, the two curves. All right. So Sheila Bishop asks, how much is the down payment on this house for those numbers? Let me go to the analysis and conventional financing tab. So again, this is a spreadsheet that you can download at jwbroi.com and you can fiddle with it yourself. But right now it looks like, Mike, we got a down payment of 25% assumption, which means that the down payment for this number of $163,000 is $40,750 at an interest rate that's being estimated at 4%. Are you seeing right now 4% interest rates? Is that what they're lending? Because I know I got mine that I bought a couple months ago, like at 3.6. Has it already kind of gone up? Have you seen that?
They're creeping. I mean, that's the direction they are heading, but I would still say for most of our lenders at 25% down, we should still be below 4%. So in context, historically, still extremely low interest rates. Are they as low as they were a month or two ago? No, but still very, very appetizing rates for long-term cash flow.
Appetizing indeed. All right, so let's to illustrate the power of this spreadsheet, Sheila, since you don't have to put 25% down, right? Like I know that when I bought mine, I put 20% down. Here is what happens on that sheet, right? I'll zoom in so everybody can see it. But now the down payment goes down to 32.6, same interest rate, mortgage payment goes up a little bit, and the ROI jumps up a little bit as well. You want to explain why the ROI goes up when you put a lower down payment in there, Mike?
Exactly right, because you're using less of your money, right? So when you really get down to return on investment, it's a ratio between how much income are you getting versus how much should you pay for it. So if I go with a lower down payment amount, I'm putting less of my money into it, using more of the banks. So I'm going to get a higher return. I'm going to get a lower monthly cash flow. So that's going to be the correlation there. A little bit higher down payment, higher mortgage payment, but I get more cash flow. Let me flip that. Higher down payment, lower mortgage payment. So I get a higher monthly cash flow, but a little bit lower ROI because I put 5% more of my money into it.
Yeah,
or if I'm looking on the long run, the least amount of money I can put into an investment, the most long-term returns that's going to generate for you.
Got it. So everybody can see, I went back to the summary sheet and now you see here it's at 10.04% and slightly lower cash flow, right? So I'm going to go back to the original one and make sure that we are all in the same boat here and I'm not messing anything up or breaking anything as I tend to do because I'm a giant man child. And now we go to Nadim's question. Nadim Shah asks, is JWB's requirement of 25% down or can one put 20% down? Well, looks like I should read my questions ahead of time. That's that one's on me.
Yep. It's really whatever's better for you, Nadim, right? I think that's where, going back to our buying plan conversation, is help to take that big picture view. And if we're focusing on maximum ROI, well, then 20% down will give us a higher return over time. If we're going to focus on how do I maximize my monthly cash flow, then 25% would make more sense for you in that situation.
All right. Now we got Sandish Gutke. I hope I'm pronouncing that correctly. Sandish, let me know if I'm getting that wrong. I try to get the names right here. He asks, who pays the utilities? Owner?
That'll be the residents. So when the home's occupied, just like landscaping costs, the residents are going to pay for all of those utilities. When they move out, JWB will get you guys set up on our account, and we'll just bill you for that usage. So you do have some utility expense, but when the home's occupied, that'll be covered for by the renters.
All right. And Sandish, just so you know, it's the first time I see your name, so I assume you're new. Welcome. Happy to have you here in the community. JWB calls them residents because their average resident stays almost 5 years, right, Mike? Like what's the average turnover rate that y'all see?
Pretty close to 5. Right now we're at 54 months. So I like to say a little over 4 years is where we're at.
A little over 4. 54. Since I don't have small children, I don't do years, but you know about that one. Nick Grandstaff has another question. Welcome back, Nick. Are the property assumptions included in the summary of returns?
Yes. So in the summary of returns, when we say that return on investment number, so the property assumptions, when we talk about the vacancy rate and the maintenance expense rate, those are factored into that total return on investment. So like Pablo's got highlighted at 8.94%. So we factor that into our total return. Maintenance and vacancy are not factored into that number right above it. The 186, that is your typical monthly cash flow.
Okay, there you go. And Jackie Hung has a question. Perfect time. And Jackie, she was just asking in the chat, but we're going to get to it. Yes, putting it in the Q&A is the right place to get it prioritized. Jackie Hung asks, the estimate in Redfin is about 102K. Zillow estimates 143K. The price around this property is around this two estimates. For example, a property 1921 Rugby Road in the same area just sold March 1st for 110K. Would you be able to elaborate a little more why this property is priced at this price point?
Absolutely, because this is the essentially. I don't need to mention that property at 110,000. I have no idea if that home was rehabbed or not. Right? Is it in some of our situations new construction or not? So the information that we're going to find on Zillow, on Redfin, on Trulia is really an aggregator of information. They're averaging sales in a neighborhood. So they're lacking that boots on the ground perspective to see has any money been put into this property. And so to put some comparison on it, JWB, when we buy properties, we're generally going to put in $35,000 as our average renovation cost. So that does lend itself to there being a difference between the property maybe next door or down the street that recently sold that maybe hasn't had that repair level. Maybe it was sold as a wholesale deal to another investor that's going to start putting some money into it. So there's a lot of reasons properties are sold, and the reason why most of our properties that are sold with conventional financing, all of them are actually appraised, is because that's where that lender really needs to confirm, is this property worth what the sales price is? What are those things that we can't see on a desktop underwrite or on Zillow? That's why we need to send somebody physically into this property to get that assessment.
Yeah, that makes a lot of sense. If I was just to delineate immediately from the question to what you just said, estimate in Redfin is 102K. Redfin probably isn't updated with the $43,000 worth of cost that went into the property improvement, which really ends up being an extra $63,000 or $61,000 worth of actual value, which I think is how we always look at homes when we're like renovating. There's always like a cost to improve and then what the value goes up. I think that makes a ton of sense, right?
Yeah, the old ARV, right? What is that after repair value going to be? And so that's really what can be missing sometimes on those websites is, all right, well, what else goes into this? And that's why that appraisal makes such a difference.
There you go. Sheila Bishop writes in the Q&A, I see tax savings and mortgage pay down on the spreadsheet. I'm not sure if that's a question, but I guess you want to talk about that. That goes into this overall total ROI, the tax savings and the mortgage pay down. Can you talk about how that affects returns?
Correct. They're going to help your returns. So that's one of the real big benefits of owning real estate, is that if you're comparing it to, like we talked about with Peloton stock or other types of investments, what's your after-tax return going to be? What are some of those bigger picture items like capital appreciation that come into play? So when we're specifically talking about principal paydown and tax savings, those are going to help your returns. And that's one of the benefits of buying the rental property, is that you're able to use leverage. You've got a renter that is making that mortgage payment for you and paying for this investment. And then you get some money left over, right? So there's a big benefit to that. You've also got here it is, we're coming up on tax time. Well, does my rental property help me keep and save my money? Or do I then have to pay capital gains or, short-term profits or taxes on those profits? So there are real benefits to the tax savings and principal paydown in terms of why we focus on real estate as an asset class. And so I like to focus on those as well in our total return. We just want to make sure we're comfortable and we distinguish between what is my monthly cash flow and then what is my monthly cash flow and then all of those additional profit centers as well.
Got it. John Lilly has a question. John, I appreciate you taking it from the chat to the Q&A. Thank you for helping me out so I don't go cross-eyed. He asks, what is the average monthly income amount tenants of these properties have? Also, are the rents increased each year?
Yeah, so I would say rents increasing at the moment, yes, is absolutely going to be market dependent. So right now, rents are increasing in Jacksonville pretty strongly. So we do have a $50 a month rent increase that takes effect in our property. So because we only do multiple year leases. So if someone signs a 2-year lease, we'll increase it $50 in year 2, or on a 3-year lease, we'll increase it in year 3. So we do currently have rent increases and an escalation schedule because the market bears it. And I believe, was your first question about the average rent rates or?
No, the average income of the resident.
Okay, so I don't actually track this. So I don't have like a hard number that I would pull to, but I think a good way for me to answer your question is that generally who are we renting to, right? And I'll compare this to the areas, the neighborhoods. For the most part, we're going to be in blue collar type of neighborhoods. We're going to be, right below that middle class type of area where you've got a good mixture of owners and renters. Really we work with a lot of those. Let's say the number one job source is the Navy, right? So you got a lot of Navy personnel support around the base, and really logistics industry, truck drivers, port workers, nurses, teachers, that blue collar, middle, right below middle class type of family is usually who we're working with. So the real key is not so much what is your income, but does your income allow you to afford the property that you want to move into, right? And based on your rental history, are you somebody who takes care of your property and will stay there for a couple of years? So we do want to make sure there is a minimum income amount to cover the rent, and we're going to look for 3 times the rent amount in that documentable income. But it's also not so important for me to just say I need somebody at X income level, because that also doesn't tell me what their expenses are, right? So you need to do that deeper dive to get beyond just what is your income and really get into how committed are you to paying your rent, what's your rental history. I mean, you got to have the minimums, but we're really looking for that individual that's going to be there for 2 to 3 years. And that's what we're really going to be looking for on that underwrite.
Cool, man. So what I'm hearing from you is boilerplate is at least a 3-to-1 ratio of your income isn't more than a third of what the rent is, but there's also a ton of homework on behavior, history, and that JWB does to make sure that it's a good fit, right?
Correct. And I think that's just a good point, because we don't just want to move somebody into a house. As you guys have seen from our conversation already today, most of it's about what happens after the person moves in, right? Year 2, year 3, year 4, are we hitting those returns? And having a property manager, having a team that's laser focused on being able to answer that question for you gives you the confidence that initial decision right? Are we finding the best renter? Do they have the best chance to stay there for a couple of years? That's the whole purpose of this investment, right? So that's where our team is really putting our energy.
Good reframe. Marilyn Cotterman from Homosassa, Florida.
Home of the manatee.
There
Woo!
you go. So once this home mortgage is paid off in 30 years, what will my cash flow be? Is the best place to answer that kind of this cash flow, this bought on cash slot right here. So if you were to buy this house on cash right now, like just, no financing, straight up, it's $770 a month would be the monthly cash flow. And I would imagine in 30 years, there's other stuff that goes into account, right? Like, I don't know, maybe you can talk about it?
Yeah, I think you actually did a really good job there, Pablo. So, in 30 years, Maryland, there's going to be some things that are going to happen between now and then. Rent's probably going up. Property taxes are probably going up, just some of those long-term pictures. But I think a good way to make that analysis is in today's numbers, right? So essentially, if I either bought this house and paid up for it cash, or let's just say I paid off the mortgage today, what would be my monthly cash flow? And that's where that 770 number comes up on this one here on Whole Cross. So now we can say it's $770 a month after that mortgage is paid off, and that's going to equate to a little over a 5% return there.
There you go. Dean Curry asks, what happens if a resident is unable to make rent payments in our new COVID world? Do they get protection from being evicted, thereby affecting the investor's cash flow? Maybe you can talk about the whole COVID experience for JWB.
Yeah, absolutely. At the end of the day, if your renter's not paying, you're certainly impacted as a property owner, right? And there's no way around that. So there's definitely been some impact from COVID and how we have to navigate evictions and the legal process. But I would say it hasn't also been a giant roadblock or challenge for our team, because for the most part, our renters have kept their jobs, right? The Florida economy in Jacksonville has pretty much stayed open. So there has not been a shutdown like in a lot of the other parts of the country. And since our economy, like I was just mentioning, is very diverse and blue collar, we weren't focused on service industries and hospitality and tourism like a lot of other areas of Florida specifically. So we're looking at our rental portfolio of homes that we manage. Today we're at about 98.5% of rent collected at the end of the month. So there has been some COVID impact, but in the overwhelming majority of situations, it hasn't been a challenge at all.
Yeah, in past calls, we've gone over this extensively. And Dean, you can check out our past podcast episodes or the YouTube channel, or even better, join our group of. We have a group of 2,500 plus investors on Facebook that are all, giving each other advice. So you can find that at jwbfacebookgroup.com. I'll put it in the chat in a second. But I think it was your historical average of rent collection was like 98.7%, and in 2020 during the COVID year, it went down to 98%, something like that.
Yeah, well, 98.5. So a little bit of a softening right around March and April, but rebounded pretty well in May and June, and we haven't really seen maybe a softening since that initial shock wave. So all in all, rent collection continues to trend very positively and strong.
And is the moratorium still in place? You know about that?
I saw your question there, Lee. I want to say yes on the Fannie Mae Freddie Mac level. I'm not 100% sure. It's a pretty fluid situation. I'd probably want to defer to my property management company and my service team to give me an update there. I probably should have a better answer for you, but I would say yes on your federal loan properties.
Yeah. And Dean, I think the episode was, we did an episode of if you look into our podcast or you look into the YouTube channel, there is one that's like, how did COVID affect 2020, right? So that's like all of it, right? Greg breaks down the different buckets, right? In that spread of like 6%, that 0.6% that dropped, he breaks down like the different people that are like, who's in eviction process, who isn't, what the different measures are. I highly, highly recommend checking out that episode. It was super, super interesting. Nadeem Shah has another question. On these older houses, what about lead paint? Is the lead paint removed during renovation before these older houses are offered to clients?
Oh, absolutely. So that's one thing that I think probably doesn't get maybe discussed enough, but one of the big values of working with our team is, that stuff is taken care of properly. So just to answer your question, Nadeem, any house built before 1978, we have to test to see if there was lead paint used or present in the past. And if we identify that it was, or if we're not sure, because we either can't test or we're just not sure, we're going to act and presume as if it is hot for lead. So now we're going to have to move forward with our repairs and renovations according to the EPA guidelines. So everything will be done and taken care of before we sell that property to a client. And remember, we're also managing this property with a resident. And so the same disclosures and information that we provide to you as the property owner, we're providing to the resident too, so that everyone is aware there is no safety hazard, there's no lead base present. We did the testing and all the work necessary to make sure we've got a safe property.
There you go. Jackie Hung, I think this is a follow-up from the first question. She puts rehabbed with nice pictures, 110K. I think, Mike, this is a good opportunity to talk. I'm sure you get a bunch of calls where it's like, well, it says this on Redfin. Why is it this? Like maybe you can describe the difference between a listing on Redfin versus what you have when you offer a investor overall.
Yeah. So, I mean, like I said, it's hard for me to say with, based off of pictures there, but I mean, there's different reasons and rationales and levels of renovation when you're looking at properties, right? So, Jackie, I'm not 100% sure, but I would want to caution when we're looking at a property and it's 110,000. When was the last time the roof was done? Was the AC done? Has the plumbing been updated? It may look nice and the cosmetics have been taken care of, but have the fundamental big ticket items been addressed? And so I think when you really get down to the guts of the property, you want to make sure that this property at the end of the day, going back to this spreadsheet on Holcroft, should perform with a 6% maintenance rate. And so I know my team has done the work necessary to ensure that's going to be the result years from now. And so I kind of got a feeling if I'm buying a house for 110,000, there's probably some deferred maintenance and repairs that I probably need to account for and adjust for. Maybe you've got a motivated seller, right? Someone who's going through a divorce or whatever situation that wants to sell this property tomorrow. So there's a lot of different reasons or inputs that go into a property and its price. But I am very, very confident that our pricing is based off of comparable sales, that if this home is appraised, the independent appraiser will be able to come up with homes of similar quality, of similar size, in a similar neighborhood. And this is what a fair market price should be.
Yeah, and let's talk about where your data comes from, Mike, right? Like I know we talk a lot about during the show how, today it's actually 6% maintenance rate, which I think is like the catalog number for what people normally plug into maintenance rates. But the idea that JWB's data comes from 3,500 properties that y'all have built or renovated and managed over the last 14 years. It's all real data of what the maintenance rate is and like based on historical performance. So if it's like a new construction on sewer, it's like 3%. If it's a renovated on sewer like this one, it's 6%. If it's a new construction on septic, which I don't know if you do, it's something else. And if it's new construction, right? Like you guys are actually using real data numbers of real comparables that have to do with your properties and how they perform. And you have like all the data tracked over the last 14 years behind it. I think that's a valuable piece to throw into that. I know that we repeat a lot on the show.
Yeah, well, and it's all true, right? It's all good information. So I think that just kind of goes back to what is our primary value, right? The reason why our clients are really excited about working with us, Jackie, is not because we're buying houses maybe for 110,000 and I'm getting a really good deal because I'm buying it below market price, right? The real key value for us is that when you're buying this house, we don't have to pull our hair out to wonder if that roof has been replaced. Has the electrical panel been done so I can get the lowest insurance cost? Has all the carpet been taken out so I've got vinyl plank flooring so I never have to worry about replacing carpet again, right? So this is more about that plug and play ability. As I'm walking into a property, all of that assessment, all of that homework, all of that effort has been done so that essentially what do I need to do is I need to hold the JWB accountable, the JWB team accountable to these returns on the spreadsheets, right? And if they can deliver on these returns And how do we get to these returns? Maintenance of vacancy is part of it. So that's all going to be factored into this. But all that work's been done for you. So that whenever you're ready as an investor, hey, like Pablo said, hey, I just sold some stock. I want to get it into some rental properties. What do you guys have available? Well, we've got 5 or 6 homes in your price range, right? Based on your needs, we can put together a portfolio of homes that look like this. And then you're able to move forward confidently. We've got the systems in place to make sure that happens over time. And that's really how we're going to be able to service you.
Beautiful, man. Mike, I know you said you got to go pick up your kid. You got time to go like another 5 minutes over on? Let's do it, man. Sheila Bishop has a clarification. So 8.94% return includes tax savings and mortgage pay down, right? I think that's a yes.
Absolutely. Yep. And just one little thing, it includes principal pay down, tax savings, but we've kind of talked a little bit about it, but I want to just make sure we record it does not include appreciation. And so like we talked about maybe half an hour or so ago, a big component to investing in Jacksonville is that growth in addition to that. So we do purposely leave off the appreciation so that we can confirm that the numbers based off of cash flow, tax savings, and principal paydown are going to be acceptable. But then on top of that, one of your biggest sources of gains over time will be from the appreciation of the property.
I'm glad you said it, Mike. Let's tee it up, man. So historical home price appreciation, right? What you all like to estimate that you can count on that has been right for the last 25, 50 years is 4.3%. Right now we're at 0. If we were to add 4.3% into the historical home appreciation rate, pop, it goes from 8.9% estimated conventional financing total ROI to 24.57% estimated conventional financing ROI. Can you explain why it jumps 16% when we're just adding 4.3% appreciation right there?
Yeah. I mean, that's really the power of appreciation, right? So if you just think, well, my property is appreciating at 4% a year, well, it goes back to what we talked about when discussing returns. Well, if I buy this with a loan, I'm only putting 20 or 25% of that capital into it. So that's another benefit of the leverage. So even though it's only 4% appreciation, you're essentially getting 4 times that benefit. So that's how you get 16% returns because, based on a small amount of capital invested, I'm going to get that capital appreciating on its own over time too. So that just points to the long-term benefit of real estate, that scarcity asset, that especially in markets like a coastal city and Florida and those big macro growth areas, the ability to get cash flow and growth is a nice mixture.
Yeah, and listen, this little trick blew my mind the first like 25 times that we did it. So, which is why I'm like, I like that we get to hit on this. But for me, when I thought about it, I'm like, oh man, so this is the only asset class, right? Like my Peloton stock did unbelievable, right? But I put all my chips onto the table and I got appreciation based on the chips I put into the table. What's happening here is the idea that you can put 20% of the chips on the table and you're getting appreciation on full chip stack, right?
That's a great way to say it. Yeah.
Yeah. So for us degenerate gamblers, yes. So it's that, right? Like you're putting in, right, at 25%, you're putting in $40,000, but you're getting the appreciation of 4.3% on $163,000.
Yeah. You don't get just 20% of the appreciation. You get all the appreciation.
Get all the appreciation. And I appreciate you all the way, Mike. I appreciate how you explain that. So, all right, let's knock out the last couple of questions here. Marilyn Cotterman from Homosassa, Florida.
Home of the manatee.
Yes. Is this home already rented and for how long is the lease? Are you familiar with
Thinking about it, it is not rented yet. So this is a property that is still in renovations. So this one is one that our team, going back to that question from Jackie, right, where we're probably putting our $35,000, $40,000 into this property. It'll be ready in a couple of weeks and be good to go.
That being said, Mike, I think it's important to clarify that by the time that an investor closes on this property, it's going to be cash flow positive month 1, right? You want to explain that?
Yeah, absolutely. Especially if we're going with conventional financing, the way things generally work out. For example, let's say this property is going to finish in about a month or so, right? So that should be about the time where we close on that property and renter will be moving in. around the same time, maybe a little bit before, a little bit after that. So essentially, when we're closing on that property, the renter is going to be in place, and we're generating income from day one.
Yeah. All right. So sorry, man. I'm over here chatting in the in the chat. Marilyn saying she loves it, home of the manatees, man. It's funny. Marilyn is
I
like
love Maryland.
yeah, it's the original inside joke from this show that never quits. And I feel like it's one of those things where it's like at first it's cool at first and it gets kind of weird, but now the more we do it, the funnier it gets.
Oh, it's got a life of its own, man.
It does.
Absolutely.
I love it. So Sandish Godke asks, do you provide SOW to the property? I'm assuming that's schedule of work, asking for a friend.
Yeah, scope of work. Yep. So we do. So for homes like this one, for example, that is still under repairs. So I won't have finished pictures, or it's, our team's working on it, but I will have our repair summary. So part of what we're able to do on our property selection call is analyze some of those specific details. Hey, Mike, I like this home on Holcroft Drive. What's going on with that repair summary? And then I can pull that up and I can send that over to you. It's going to itemize out what was spent and where, and that gives us a good visual, let's say a good representation of what repairs and work goes into that. So we absolutely will provide that scope.
Outstanding. Last question from Marilyn Cotterman from Homosassa, Florida.
Home of the manatee!
Now you're making it weird. All right. I know Mike is an investor, but just curious, is he also a realtor broker?
I am, actually. So if you want to know the story, I was our original broker back in the day when I started our property management company about 11 years ago. But I've sent that mantle off to Melissa Gillespie on our team here. And so she now is our real estate broker.
That is funny, man. We just had Melissa on as the guest.
Oh, that's right. I totally forgot about that.
Yeah. So you guys are, and by the way, she was the first time ever two-time returner. You're the second two-time, right? So it's like, and by the way, she gives you a run for your money, Mike. She is quite good on the show, but you have held your own, my friend. So
I appreciate it. Well, that makes me feel good because I kind of feel like Melissa is the student who has become the master. She was I guess a protege on the property management side, and now she is just blowing it up and done even better than any of us could have imagined. So she's phenomenal.
Awesome, man. Last question, so you can go pick up your kid from school. Nick Grandstaff asked, do clients come to Jacksonville before they purchase a home, or is it all done sight unseen?
It's generally going to be done remote, sight unseen. I've got videos and tours and things like that, but just with the way the world has been going recently, COVID restrictions, all sorts of challenges, you're certainly welcome to come down here and cruise around and take a look at areas and neighborhoods, but for the most part our conversation is going to be done virtually. It'll be done remote ideally, and we want to make sure you're comfortable with how we're operating and the properties before we're ready to purchase them. So it really goes back to our conversation, and let's do like we did today. Answer your questions. Let's break things down. Let's go through the numbers. Let's go through the market. Let's go through the big picture. Let's get granular. Let's essentially do all that homework that you would do in a site visit, but do it through a couple of phone calls and screen share sessions.
There you go. And Nick, to give you a little bit of insight, man, what I've learned as the host of the show, I'm not really a real estate expert, FYI. I just play one on TV because I get to share the screen with real estate experts. But I've learned that this is all about trusting the team of JWB, right? Like the real estate purchase is a one-time thing, but the relationship with your property manager and the team that takes care of all of it is a full-time, for the rest of the life of it, right? So I know that that's what they really, really lean into. And obviously me here, and I get to do this twice a week, and I'm here all the time. And you're going to see that we have a lot of people that come every week as well. That's part of our community. But this is going to be the second purchase I buy in Jacksonville. I live in Jacksonville. I have not seen the first one. I'm not going to go see this one, right? Like it's really just like, this is a pro forma. This is the way that it's going to maintain. Like I never asked to go see the, the bonds that I buy off of a company. I never go to the company and walk around their warehouse either. You know what I mean? So like, I think this is a different asset class. So it's tangible and that's there. But from what I understand, it is a very commonly sight unseen process that's become more sight unseen now that it's COVID era. But, I guess it just comes down to your level of comfort, but it is mostly sight unseen, right? If I'm not mistaken.
Oh yeah, absolutely. Right. And we acknowledge this is a little unusual, right? Especially for new investors, like we talked about with Pablo, right? He lives here in Jacksonville. He's a good friend of mine. it was still nerve-wracking and a little anxiety building to buy the first house. So it is totally natural and normal. That's why we have our conversation this way. We don't just jump right into buying a house together, right? And then ultimately have a ton of questions and, beat myself up and why I did this. So let's take a couple of steps and go from the beginning. What are you trying to do as an investor, right? Does it make sense to invest with us? Does our market, does our team, do these properties all get you to where you want to be? And if we can answer those questions first, then it's a lot easier for us to move forward, right? Let's figure out your game plan. How can we execute this? It's going to be a little unusual to buy a property in a city that I've never been to, but like Pablo said, if we can buy into that belief in the team and ultimately the results that I see and other clients have experienced, and if I have a team that I feel confident can deliver in this results, not just month one, year one, right? But year 2, 5, 10, that's where you can make confident, informed decisions, and let's move forward.
Yeah. And again, when I talked to Greg about this show last, November 2019, we kind of started the conversation. That's what the show's all about, man. It's, showing up week after week. You understand that. So this is just a frictionless way, Nick, for you to get comfortable with what's going on, right? Like I know that Marilyn and Lee have like not missed a show since March, right? And I think Marilyn just made her first purchase. I was, JWB's hype man. And I, I've been hosting the show for over a year and I made my first purchase to start the beginning of this year. So, it's up to you, man. We're going to be here every single week. So you get to be comfortable with the message. If you want to come to Jacksonville, check it out. Jacksonville's awesome, right? Like I love it. But again, this is the whole, it's making it easy for you. Kind of like what y'all have always been doing. It's just make buying rental income properties as easy as buying bonds, right? So Stets, you killed it, buddy. You killed it. You did awesome. Again, love your energy. I love the LeBron James-ness of what you do out here.
I just blew up my ankle.
You're cramping. More than anything, just really appreciate the idea that we've had 42 people with us in the middle of a Thursday. I know that that's not a small ask, and that is that is really what rewards us for feeling that we're putting out value. If you devote an hour of your time here, it means that we're doing something that's worthwhile. So really, really appreciate it. Like we say, the community drives the show. It's an honor to represent you here. And join us in the Facebook group so we can all hang out, jwbfacebookgroup.com. If you want the spreadsheet, go to jwbroi.com. On Tuesday, Greg is going to be back, and we're going to be having a point counterpoint of what turnkey is versus what vertical integration really, really means. We've been driving home the idea that JWB isn't just turnkey. Too many people call themselves turnkey. JWB is truly vertically integrated, from owning the land before the property is on it to investing in downtown to making moves downtown and being like a decision maker in the macro economy of the city, total to being here for the next 30 years and not being in any other market, right? So total vertical integration and what that means to you. We're going to nerd out on the term and we're going to say vertical integration at least 100 times. So I hope that somebody, Lee, I'm counting on you to be the counter, the VI counter. Mike, great job, buddy. I'll leave it to you to kind of give last words here and as a final goodbye, man. But you absolutely killed it. I appreciate your time, man. And thanks for sending me over that paperwork earlier today, man.
Oh, absolutely, guys. And if anyone has any questions, just call me.
All right, see ya.